Every strategy you have learned so far requires a directional view, bullish, bearish, or neutral. The straddle and the strangle are different. They are designed for situations where you know a big move is coming, but you do not know which direction. Earnings announcements, Federal Reserve decisions, major product launches, regulatory rulings. These are binary events where the outcome is uncertain, but the magnitude of the market reaction is predictable. The straddle and strangle let you profit from the move regardless of direction. If the stock surges 20%, you profit. If it crashes 20%, you also profit. The only scenario where you lose is if the stock barely moves at all after the event. In this video, I will show you exactly how both strategies work, how to build them on Apple around an earnings event, the numbers that determine your break-even, and the one critical timing mistake that destroys most traders who use these strategies. A straddle is the purchase of both a call and a put at the same strike price, on the same underlying and the same expiry. You buy an at-the-money call and an at-the-money put simultaneously. If the stock moves up sharply, the call gains value and more than offsets the cost of the put. If the stock moves down sharply, the put gains value and more than offsets the cost of the call. One of the two options will always lose money. The question is whether the winner gains enough to cover both premiums paid. The total cost of the straddle is the combined premium of both options. That combined cost sets your break-even. The stock must move at least that much in either direction from the strike price by expiry. The straddle is the purest expression of a non-directional, high-magnitude bet. You are not predicting direction. You are predicting that the stock will move more than the market expects. A strangle is similar to a straddle, but uses out-of-the-money options instead of at-the-money options. You buy an out-of-the-money call at a strike above the current price and an out-of-the-money put at a strike below the current price. Because both options are out of the money, they are cheaper than at-the-money options, so the total premium paid for a strangle is lower than a straddle. Lower cost means a lower absolute dollar risk. But lower cost also means a larger required move. The stock must travel further in either direction to reach break-even, because you start from strikes that are already away from the current price. The straddle concentrates at the money with higher premium and lower required move. The strangle spreads out of the money with lower premium and higher required move. Both profit from large moves in either direction. The choice between them depends on how large you expect the move to be and how much premium you are willing to pay. Implied volatility is everything with straddles and strangles. The market prices options based on its expectation of how much the stock will move. Before a major event like earnings, implied volatility rises dramatically. The market is pricing in a large potential move. This inflates the premiums of both calls and puts. When the earnings announcement is made, the uncertainty resolves and implied volatility collapses instantly. This is for crush. If you buy a straddle or strangle after implied volatility has already been inflated just before the earnings announcement, you are buying at peak premium. Even if the stock moves significantly, for crush can destroy the value of your options faster than the directional move builds it up. The critical rule: buy straddles and strangles when implied volatility is still low, before the market has priced in the expected event. Buy early, not at peak fear. Apple is trading at $182.50. Earnings are announced in 3 weeks. Implied volatility rank is currently at 35%, still moderate, not yet at the pre-earnings peak. You decide to enter a straddle 2 weeks before earnings to capture the 4 expansion as earnings approach, as well as the post-earnings move. The at-the-money straddle: buy the $182.50 call at $5.50, buy the $182.50 put at $5. Total debit: $10.50, $1,050 per contract. Upper break even: $182.50 plus $10.50 equals $193. Lower break even: $182.50 minus $10.50 equals $172. Apple must close above $193 or below $172 at expiry for the trade to be profitable. That is a $10.50 move in either direction, roughly 5.7% from the current price. The strangle on the same Apple earnings trade: instead of buying at-the-money options, you buy out-of-the-money options. Buy the $190 call at $3, buy the $175 put at $3. Total debit: $600 per contract. Significantly cheaper than the straddle's $10.50. Upper break even: $190 plus $6 equals $196. Lower break even: 175 minus 6 equals $169. Apple must close above 196 or below 169 at expiry, a move of 1350 or more in either direction. The strangle requires a larger move to break even but costs $450 less per contract. Key comparison: straddle costs $10.50, break even at 5.7% move. Strangle costs $6, break even at 7.4% move. If Apple historically moves 10% or more on earnings, the strangle is more capital efficient. If it typically moves 6 to 8%, the straddle's lower break-even wins. The profit and loss diagram for the straddle at expiry. Horizontal axis, Apple's price at expiry. Vertical axis, profit or loss. The shape is a V. At the center, the strike price of 182.50, you reach maximum loss, the full 1050 debit. Moving left below 182.50, the put gains value as Apple falls. At 172, you reach break-even. Below 172, the position is profitable, with profit increasing for every dollar Apple falls further. Moving right above 182.50, the call gains value as Apple rises. At 193, you reach break-even. Above 193, the position is profitable. The V-shape means maximum loss sits at the center and profits grow in both directions as the stock moves away from the strike. The straddle is the one strategy where you want maximum volatility. The further the stock moves in either direction, the more you make. On Tiger Brokers, navigate to the Apple options chain and select the expiry that captures the earnings date with approximately 7 to 14 days after the announcement. Go to the at-the-money strike, 182.50. Buy one call and one put at this strike simultaneously. Enter both as a single straddle order or as two separate market orders at the mid-price. Total debit displayed in the Tiger ticket, $10.50 per share, $1,050. The platform automatically shows your upper and lower break-evens. For the strangle, navigate to the 190 strike on the call side and the 175 strike on the put side. Buy one of each. Enter a limit debit of $6 for the combined strangle. Tiger displays the wider break-evens automatically. Important: enter straddles and strangles using limit orders during regular trading hours when bid-ask spreads are tightest. Avoid entering immediately before or after major market open when spreads widen significantly. Scenario 1. Apple beats earnings and surges. 3 weeks later, Apple reports record revenue, and the stock gaps up $15 to $197.50. For the straddle, the call is worth $15 intrinsic value. The put expires worthless. Total position value, $15. You paid $10.50. Profit, $4.50, $450 per contract, a 43% return on the premium paid. The upper break-even of 193 was exceeded by $4.50. For the strangle, the 190 call is worth $7.50 intrinsic. The 175 put expires worthless. Total value, $7.50. You paid $6. Profit, $1.50, $150 per contract. The strangle break-even of 196 was not reached on a $15 move. The straddle won this scenario because the break-even was lower, despite costing more. A $15 move on Apple, 8.2%, is significant, but the straddle still delivers better return. Scenario 2. Apple misses earnings and crashes. Apple reports weaker than expected guidance, and the stock falls $20 to $162.50. For the straddle, the call expires worthless. The 182.50 put is worth $20 intrinsic value. Position value, $20. You paid $10.50. Profit, $9.50, $950 per contract, a 90% return. The lower break-even of 172 was exceeded by $10. For the strangle, the 190 call expires worthless. The 175 put is worth $12.50 intrinsic. Position value, $12.50. You paid $6. Profit, $6.50, $650 per contract. The strangle lower break-even of 169 was also cleared on this move. Both strategies were profitable on a $20 crash. The strangle returned 108% on a $6 investment versus the straddle's 90% on $10.50. The strangle wins when the move is large enough to clear both break-evens by a wide margin. Scenario 3. Apple reports in line and barely moves. The earnings announcement is neutral. Apple meets expectations exactly. The stock moves only $2, closing at $184.50. For crush hits immediately after the announcement. Your straddle. The call is worth $150 intrinsic. The put expires worthless. But 4 has collapsed from 35 to 18. The call's time value has been destroyed. Total position value, approximately $2. You paid $10.50. Loss, $8.50, $850 per contract. This is the danger of buying straddles and strangles. If the stock does not move enough to overcome both the premium cost and 4 crush, the loss is near total. The 4 crush trade, buying the straddle for 4 expansion, not for the earnings move. This is the professional approach. Apple earnings are in 2 weeks. For rank is 35 now and will likely reach 60 or 70 by the announcement. You buy the straddle at $10.50 when 4 rank is 35. 1 week later, 1 week before earnings, 4 rank has moved to 60. The same straddle is now worth $12 because 4 expansion has inflated both option premiums. You close the straddle the day before earnings for $12. Profit, $150, $150 per contract, without taking any earnings risk at all. You captured the 4 expansion and exited before the 4 crush. This strategy requires no prediction of the earnings outcome, no directional view, and no exposure to the binary event. You are purely trading the volatility cycle, low 4 before the fear builds, exit before the uncertainty resolves. Straddle versus strangle, choosing the right tool. Use the straddle when the expected move is moderate, in the 5 to 8% range, because the lower break-even gives you a better chance of profiting on a smaller move. The higher cost is justified by the tighter break-even when you need precision. Use the strangle when the expected move is large, 10% or more, because the lower cost improves your return on risk if the move clears both outer strikes. The strangle is more capital efficient on large moves, but requires a bigger swing to be profitable. Both strategies share the same critical condition. Enter when implied volatility is relatively low before the event premium builds. Never buy a straddle or strangle the day before a binary event when 4 is already at its peak, for crush will almost certainly destroy more value than the stock move creates. The timing of entry is more important than the choice between straddle and strangle. Complete straddle and strangle summary. Underlying. Apple at $182.50. Earnings in 3 weeks. For rank at 35. Straddle. By $182.50 call at $5.50. By $182.50 put at $5. Total debit. $10.50, $1,050. Upper break even, $193. Lower break even, $172. Required move, 5.7% in either direction. Maximum loss, $10.50 at the strike price. Profit, unlimited in both directions beyond break-evens. Strangle, by $190 call at $3. By $175 put at $3. Total debit, $6, $600. Upper break-even, $196. Lower break-even, $169. Required move, 7.4% in either direction. Maximum loss, $6 between the 2 short strikes. Entry strategy, by 2 to 3 weeks before binary event when 4 rank is below 50. Exit option 1. Close before the event to capture 4 expansion only. Exit option 2. Hold through the event targeting the post-announcement directional move. Here is what you now know. 1. A straddle buys a call and a put at the same at-the-money strike, higher cost, lower break-even, profits from moderate moves in either direction. 2. A strangle buys an out-of-the-money call and put, lower cost, wider break-even, more capital efficient on large moves. 3. Both strategies profit when the stock moves significantly in either direction and lose when the stock barely moves. 4. Implied volatility timing is critical. Enter when 4 is low, before the event builds premium into the options. Buying at peak 4 guarantees 4 crush will fight your position from day 1. 5. Consider closing before the binary event to capture 4 expansion alone, removing the directional risk entirely. That is the professional use of the straddle. Series 2 continues with the calendar spread, the strategy that lets you sell short-term theta while maintaining long-term directional exposure, video 17.